Well, despite fears of a slowdown, which has led to a very sharp correction in IT stocks, remember the Nifty IT index is down more than 25% from the start of the year. The demand is expected to be fairly strong and the numbers this quarter. So here's what the CNBC-TV18 poll expects. Roughly a sequential growth of 2.5% to about 4.5%, with Infosys leading the growth with about a 4.5% constant currency quarter-on-quarter revenue growth, followed by TCS at 3.5%, and then you've got Wipro, HCL Tech Mahindra. Approximately, we're expecting about a 2.5% revenue growth on a quarter-on-quarter basis. But this quarter is also marked by very large cross-currency losses of about 100 to 200 basis points, which is why the US dollar revenue growth is expected to be lower at 1.3 to 3.3% on a quarter-on-quarter basis. Let's move on and now talk about the margins. Well, margins are likely to contract across the board by about 40 to 170 basis points. TCS and Infosys, both of them have rolled out their wage hikes effective 1st of April. Wipro will start giving hikes from 1st of June, so that's going to weigh on the margins. But apart from that, elevated hiring, attrition, though it has started declining, it is going to weigh on the margins, and margins are likely to be muted. It's also the start of the year, so the guidance is going to be crucial. Infi and HCL Tech have already given us an annual guidance, and the expectation is both the guidances will remain unchanged. So for Infi and HCL Tech, revenue growth will be maintained at 12 to 14% and margins too will be maintained. But the investor attention this time is not going to be on these numbers, but it's going to be more about the commentary, the potential demand slowdown and the impact of the weakening macroeconomic outlook on deal conversion. Also, the margin outlook is going to be very crucial. Remember, margins have already corrected about 300 to 500 basis points from their post-COVID peak levels. And now margins are pretty much back to pre-COVID levels. The question is, will price hikes, the INR depreciation, provide a margin tailwind going ahead? And finally, as I started off saying, the Nifty IT index has fallen more than 25% from the start of the year, and most of it is due to a PED rating. This is how the valuations stack up. Well, as you can see over here, valuations are still above the pre-COVID 3-year average. So the question now is how much of it is already priced into the stocks. We've seen a derating, and what can excite the stocks from here on. Here I'm quoting some brokerages. Starting with Kotak, they say that IT stocks have corrected and they've already built in a slowdown in spending. But a recessionary environment is not fully captured in the stock prices. CLSA says the uncertainty on the scale of macro headwinds could continue to weigh on stock valuations despite the 20 to 50% correction from their 52-week high levels. While UBS says a major positive stock reaction is unlikely without upward revision in the guidance given by companies, given the demand elusiveness beyond the first half of this year.